This is question time at Heimer Investments for a Friday, the last day of the week. And we're going to bring in Joe and Steve. And I think it's interesting, guys, that this today we get to talk about something we have watched for 2 years. And now finally, we're going to talk about the dollar breaking out. Joe, I can just see you're so excited about that.
Well, I said we need a solid close above 107. We're not quite there yet. We are at 107 and a half this morning. It's a pretty interesting move. That would be the highest level since let's see, October of 2022. So it has been a couple of years. And it's interesting. But I just want to go over some of the main stuff that happened this week. We use Fridays to go over the weekly economic reports and so forth. I'm just going to cover that. It's not a whole lot of news there. The big news for the week is the dollar, but we should cover this other stuff too. Um, a lot of the news this week was on housing, which was, it was okay, I guess. The housing index, housing market index, which is essentially a survey of home builders, went to 46. It's almost to 50, guys. 50 is the area. Over 50 is good, under 50 is bad. We're at 46. It was up from 43. Yeah, again, it's kind of meh. It doesn't mean all that much. Building permits and housing starts were down. Both were down. I think starts were down 3.1%. They're trending down. If since April of 2022, that's when it peaked at a much higher level than where it is now. I'd have to pull out the numbers and see exactly how much it's down, but it's quite a bit. But right now, it's right about the average. If you look at the average since 1990, it's just about average. The problem is if you look at the average since 1960, it's way below. So if you think about that, it's kind of weird because there's a lot more people in the country now than there was, say, in 1970. But we were building a lot more houses back then, which is kind of weird. Anyway, the housing market has been a problem. There was one other report. Existing home sales were up 3.4%, but you got a big old caveat there. Existing home sales are based on closings. So the deals for these existing home sales were struck in September when interest rates were a lot lower. I remember we had mortgage rates go all the way down to 6 at one point, almost to 6 in September. There was a lot of activity then, and we talked about this when we got what was called the pending home sales. I think that was a couple of weeks ago, and so we knew this existing home sales number was going to be up. It was up about 3.4%. Not huge, but not unexpected either. I think that the other kind of big news this week was on the manufacturing side of the economy, which we talked about some. The Philly Fed did was actually turned negative, but it was all based on current conditions. All the forward-looking stuff was very, very positive. Kansas City Fed improved slightly. That's a small region, so it doesn't really make all that much difference on the manufacturing side. And then today we got the composite PMI from S&P, which was at a 55.3 up from 54.1. That's a big number, but it's all services. The manufacturing piece went from 48 and a half to 48.8. Woo, really up big. but the services side went from 55 to 57. And that 57 number on services is a big number. And the last thing we got this week was University of Michigan Consumer Sentiment, which was up 71 and change. I don't know the exact number off the top of my head. It was up like a point. I was a little surprised it didn't go up more because I'm pretty sure that the second half of that survey was done after the election. So I'm a little surprised it didn't go up more, but I think probably to get a clean number, we'll have to wait till next month. We know that that survey in particular is heavily influenced by people's political leanings. So on our main big indicators, the 10-year Treasury note yield, it dropped 2 basis points. It did nothing this week. So that really doesn't change anything. Still in the same trend it's been in. The dollar is breaking out this morning, up 107 and a half on the dollar index. And by the way, the yuan has come down some over the last month. But if you look at the yuan, the Chinese currency, it's about the same place it was in 2022. So that hasn't really changed all that much. The big move in the Dixie has come against the euro. The European economy reported they're contracted in the most recent quarter. European economy is having some real struggle here. And so I think the main takeaway from the dollar is that it's about the euro and about the European region. And so I think that that may have some impact on our portfolio strategy or tactics. But we don't do anything to the end of the month. So we'll see where things are at the end of the month. Like I said, I think it's Eurocentric. It's not necessarily the whole world, but it is about Europe. And of course, it does have something to do with the election and so forth. We'll see how that plays out in the next couple of months.
So, Steve, tell me what you think because I know you love to talk about the dollar. So, where are you on this?
Yeah, no, it's definitely noteworthy that we may be having a technical breakout here. You and I were having an offline conversation where I mentioned that there's really not a lot of pure technicians out there, and you want to look at other things, some fundamental analysis. There's also things you can bring in like sentiment and stuff, and Joe might have a few thoughts on there. But yeah, it's a big model for us is the dollar and rates paradigm. The dollar is, really something we follow a lot here, can impact how we structure the portfolios. Also maybe, interesting that the dollar at the beginning of the month was actually showing some strength against gold, and that seems to have gone away, given a lot of that back. And then I think, we're going to kind of see where this goes. We're right on the cusp maybe of some developments here. What we're not on the cusp of on the bond side is, I think the bond market at this point is clearly signaled it's moving in a different direction than what the Fed wants. So the Fed cut 50 beeps. The Fed then did another quarter point cut, and what we've seen is the bond market moving in the opposite direction, rising in rates, and now, as Joe mentioned, that about 4.4% on the 10-year is where we've been kind of trending sideways around. So to me, that's probably at this point the more interesting thing we can start to say with some level of clarity is the Fed get into that 2% inflation level. Doesn't look like it's happening anytime soon. That the bond market is saying we're not pushing rates back to the pre-COVID era. That's just not in the cards right now, and that we're kind of what Joe and I have talked about back into kind of the new normal level of rates, but one that we really haven't seen in the post '08 world. So there's a lot of people who've only known a rate environment, a lower rate environment that we're just probably not going to be existing or operating in anymore. So those, at least on the DARP front, those are some of the things that jump out at me.
So, Joe, talk about whether, in your opinion, this is really a breakout for the dollar and about people's sentiment over it.
Well, yeah. Look, I'm a little skeptical of it because it is very Eurocentric. So I think that we got to be careful here that we don't draw some big, broad conclusion about what's going on right now. I think if you look at monetary policy in Europe versus the US and Japan versus the US, because the yen and the euro are the two biggest components in this index. Japan's monetary policy looks like they're going to continue to tighten. I would expect another rate hike in January. Europe's going the opposite direction. They're still cutting. And the US, as Steve was pointing out, seems to be we're kind of stalled here. And if you look at expectations for Fed policy in the future, the bottom end has come up. In other words, the terminal rate is higher now than it was, say, 6 months ago. But I will say too, on sentiment, I think I want to check some things over the weekend. We're probably going to do something very soon on sentiment because I think some things are getting pretty frothy here. But it's kind of interesting, actually, on the short term, the bond market looks a little oversold here. And what I mean by that is there's a lot of people on that side of the boat, a lot of people thinking that bond yields have to go up. And you know me, I'm Mr. Contrarian. I always want to swim upstream. I suspect we're on the verge of a little bit of a rally in bonds here. And looking at it from a longer term perspective on a technical basis, actually, it kind of makes sense here. We're kind of making a technical higher low on bond prices. So it's going to be interesting to see how this plays out. I suspect you may see bonds rally a little bit into the inauguration because I think people are going to get a little bit worried about because they don't know what's going to come. They don't know what's going to happen. And so people kind of rush for safety when they do that. We'll see. Maybe I'm wrong, but sentiment wise, I think people are really pushing it hard on number one that the U.S. is going to be the only place to be, and also that the economy is going to boom. And bonds are not saying that, not yet anyway. And if bonds start going the other direction where they're signaling slower growth, that's going to be a very interesting dichotomy between the dollar, which is signaling strength, versus the rest of the world, and the bond market, which may not. So we'll see how it plays out. Look, maybe bonds are just going to follow the dollar. Everything's going to go higher, but I don't think that's the way it looks right now. So be very interesting the next few weeks.
As Joe said, we've got some very interesting conversations coming up next week. So be sure you're here. And if you have comments, put them in the comment section down below.